Now coming to cash flow statement, which is again part of your financial statements of the companies. What is cash flow statement? It shows basically how cash and cash equivalents have changed during the year. Because your balance sheet doesn't show the movement of cash and cash equivalents, it shows just the cash position as on a particular date. Your statement of profit and loss is prepared based on accrual. So again, it doesn't show the cash movement. So that is why the separate cash flow statement is prepared to show how the cash has come in and how the cash has gone out of the business. The entire cash flow statement is basically divided into three categories: cash flow from operating activities, investing activities, and financing activities. Now, what is operating activities? Which is the regular course of the business, right? So sale of goods, purchase of goods, salary, wages paid to the people, electricity, insurance expense. All these are all the items which are incurred in the regular course of the business, or which are earned in the regular course of business. So all the receipts as well as payments related to such items will be basically part of your operating cash flow. Investing cash flow typically is basically for the cash movements that are happening in case of non-current assets or the investments. So the investments, the plant and machinery, furniture, land and building, investments made by the company. All these basically the items will come under investing category. So any cash. So for example, if you have sold any fixed asset, that will be cash inflow from investing activity. If you are purchasing a machinery and paying money, then it is a cash outflow from investing activities. Then the third category is financing activities. So this will include all your shareholders' funds and non-current liabilities. These are all the borrowings or the amounts raised to finance the business. So for example, interest on debentures, cash flow from financing activities. Shares issued, cash inflow from financing activities. Dividend paid, cash outflow from financing activities. Now there are two methods in which you can prepare the cash flow statement. One is called direct method and another is called indirect method. Now in direct method, what you do, for these three activities, operating, investing and financing, you actually show how much cash received, how much cash paid. So you show the actual receipts and payments under each of these categories. But this direct method is typically a tedious method, because in the whole year, identifying the actual receipts and actual payments becomes a very tedious activity. So that is why normally the companies prefer indirect method. And in the indirect method, you start backwards from profit as per the statement of profit and loss. And then, the profit is obviously a result of all revenue expenses and revenue income based on accrual. So that is why all non-cash expenses are basically added back to the profit, because these are non-cash expenses and these are actually not cash outflows. So that is why these are added back to the profit, and any non-cash income or gains are basically deducted from the profit, because these are not actual cash inflows. Net cash which is generated from all these three activities, operating, investing and financing, during the year, plus the opening cash and cash equivalents, will give you the closing cash and cash equivalents, which has to tally with your balance sheet. Sometimes there can be a negative balance. That means net there is a cash outflow. So in that case, what will happen? Your opening cash and cash equivalents minus the net cash used in all these three activities will give you the closing cash and cash equivalents. Final accounts. Now this we will be solving as per revised schedule 6. So these are the practical questions, financial statements of the companies. Okay, this is the question. Auto Parts Manufacturing Company Limited was registered with a nominal capital of so much, of which 40 lakhs shares had been issued and fully called up. All amounts mentioned below are in rupees thousands. And this is a trial balance that is given. And below that, there are certain adjustments given. Write-off 1/3 preliminary expenses, depreciation, manufacturing outstanding wages and office salaries outstanding, interest on bank loans, stock, loose tools, closing stock. Provide for 850 on debtors for doubtful debts. This is discount on debtors. Make a provision for income tax. Directors recommend dividend at 15% for the year after transferring 5% of net profits to general reserve, and make a provision for dividend distribution tax at 17%. So let us go one by one. This is your opening stock given in the trial balance. So this will be basically part of your changes in inventories. So 18,642. What you will do is basically opening stock will be added and closing stock will be deducted. So 18,642. This will be basically the opening stock. That will be part of your changes in inventories. Then manufacturing wages 10,974.
that will be part of your employee benefit expenses. And let us go to note number 1. Manufacturing wages 10,974 and you have in the adjustment 189. So 10,974 is basically part of your manufacturing wages. Manufacturing expenses 1,924, that will be part of your other expenses. Note number 4, 1,924 is your manufacturing expenses. Purchases 71,821, that will be part of your adjusted purchases, 71,821 here. And sales 116,990, that will be your revenue from operations, which is 116,990 here. Machinery repairs 861, that will be again part of your other expenses. So machinery repairs, carriage inward, carriage outward, these three will be part of your other expenses, which is basically 861, 491 and 926. That is note number 4. Then advance payment of income tax will be basically deducted from your provision for income tax in the balance sheet. So if you go to balance sheet, 1,429 will be basically, that is the advance that you have paid against the provision that you have made. So that is why it will be deducted from the provision. Okay. Then 18% bank loan 5,000, part of your non-current liabilities 5,000. Interest on loan, and obviously is interest on the above bank loan. Now please note that 5,000 is your bank loan and 18% is the rate of interest. So your total interest is going to be 900. 450 is appearing in trial balance. That means remaining 450 is outstanding. So in your statement of profit and loss, the total interest that you will show will be 900. Remaining 450, that will be your outstanding interest on loan. So if you go to, and this interest on bank loan will be part of your finance cost. So if you go to, that is your 900 overall interest. And if you go to note number 2, interest on 18% bank loan 900. This is 450 as per trial balance and 450 outstanding. And this 450 which is outstanding, that will be part of your current liabilities because it is supposed to be paid in the short term. So current liabilities, other current liabilities 450. Note number 5, we have shown it separately. Then debtors, creditors, part of your balance sheet 16,440 and 9,222. So creditors will be part of your trade payables 9,222 and debtors will be part of your current assets 16,440. Then profit and loss account 864, that is the opening balance, opening accumulated balance. So that will be forming part of your reserves and surplus notes to accounts 864, that is your opening balance in statement of profit and loss. Then bank current account 10,686, that will be part of your current assets and it will be part of your cash and cash equivalents 10,686. Cash in hand 192, again that will be part of your cash and cash equivalents 192. So this is done. Leasehold factory, plant and machinery, these will be part of your non-current assets. So 16,421 and 12,842, which will be part of your tangible assets. Note number 7, 16,421 and 12,840. Then you have loose tools 1,250 and there is some adjustment about the loose tools. And it says the stock was valued at so much and the loose tools were valued at 1,000. So the loose tool that is appearing in 1,250 in trial balance is 1,250 and the stock is only 1,000. That means remaining 250 is basically what is consumed. So 250 will come in the statement of profit and loss, that is under depreciation column 250. It is either consumed or basically written off, and part of your inventories 1,000, that is 1,250 minus 250 because the stock is 1,000. So that will be basically part of your closing stock in inventories. Share capital 40,000. You will have a separate note and it says basically in notes you will have authorized share capital 1 crore shares of rupees 10 each. All the rupees are in thousands, so 1 lakh thousands, and then 40 lakh equity shares 10 rupees fully paid up 40,000. That is your share capital. This is basically a called up share capital. Then you have calls in arrears. Now calls in arrears will be obviously deducted from share capital. So these calls in arrears will be deducted from share capital. So that is 100. Net 39,900 will appear in your balance sheet as the paid up capital. Rates and electricity, directors fees, so 1,761 and directors fees 1,200. That will be part of your other expenses. Office salaries, part of employee benefits 1,300. And you have actually 1,300 and you have outstanding office salaries in the adjustments 120. And this outstanding salary as well as outstanding manufacturing wages, that will be part of your current liability. To go to the current liabilities, outstanding manufacturing wages 189 and outstanding office salaries 120, which we have already added in statement of profit and loss. Auditors fees 125, part of your other expenses. Office furniture 500 will be a part of your tangible assets. Office furniture 500. Commission 860, so that is commission on the debit side, so that means it is allowed. So 860 will be part of your other expenses. Commission. Then returns, debit column means sales returns and this is purchase returns. So 1264 will be deducted from your sales. That is this. So with that sales amount is done, and in purchases this 981 will be deducted. So this is purchases, adjusted purchases. Then preliminary expenses 600. These are debit balance, so it will be basically a written off over a period of time. So since it will be written off over a period of time, it will form part of your non-current assets, and in non-current assets you will write it as against other non-current assets. So 600 will be in other non-current assets. So other non-current assets, here basically you have some adjustment. So 600 is basically the original amount as per the trial balance, and then if you go to adjustment, it says write off 1/3 of preliminary expenses. So 1/3 of 600. So that is 200, right? 200 has to be written off. So if 200 is written off, obviously what will remain in balance sheet is 400. So 600 minus 200 written off, 400 will remain in your balance sheet. And this 200 which you are writing off, obviously that will be part of your statement of profit and loss. And that will be basically part of your other expenses. So trial balance is over. Then depreciation 15%, office furniture 10%. 15% and 10% plant and machinery and furniture. So 10% furniture, that is 10% of 500 and 15% of 12,840, 1,926. So all that will be deducted from the assets. So this is done. And then this depreciation will be part of your statement of profit and loss. So 1,926 and 50 rupees. That will be part of your statement of profit and loss. You will have a separate schedule, notes to accounts, 1,926 and 50 rupees. So manufacturing wages, outstanding 189 and 120 office salaries that we have already seen. We have added it to the respective items in employee benefits, and it is already part of your current liabilities. We have added that there. So this is done. Provide for interest on bank loan for 6 months. That is also we have already done. Overall it is 900 rupees interest, which is 18% of 5,000. So that will be part of your finance cost, right? And this 450 is already there in trial balance. So remaining 450 is outstanding. That is basically nothing but your other current liabilities, because it is supposed to be paid in the short term. Even if this adjustment was not given, you would have anyway shown this as an outstanding interest, because it is a hidden adjustment. Stock was valued at 12,484 and 1,000 is your loose tools. So loose tools we have already done. Closing stock also what we have done is we show it against the changes in inventories. So opening stock minus closing stock. So 12,484. Opening stock was already part of your trial balance, and closing stock will be now part of your inventories in current assets. So 12,484, and plus you had 1,000 loose tools, that is 1,250 minus 250. So this is done. Then provide 850 rupees on debtors for doubtful debts. So you have to make a provision now. Now provision for doubtful debts 850 again will be part of your other expenses, and it will be deducted from your debtors. 850 deducted from debtors. So 16,444 was as per the trial balance. Then provide further rupees 312 for discount on debtors. Again same treatment. 312 discount on debtors will be part of your other expenses, and 312 will be deducted from your debtors. So net 15,278 is basically your trade receivables. If you go to balance sheet, 15,278. Then make a provision for income tax. Obviously it will be on profit before tax. So we'll see that later. Recommend dividend at 15% for the year. That will be obviously again after paying tax, after transferring 5% of net profits to general reserve. Make a provision for dividend distribution. Okay. So first let us close the statement of profit and loss account now. Now this we have seen. So this is your total revenue. There is no other income. In employee benefits, note number 1, we have already seen both the items, 12,583. So this is also done. That will be your employee benefits expenses. Note number 3, that was for depreciation. We have already seen it. So 2,226. Then other expenses, 9,510. That is basically the notes to accounts which we have already seen. So this is 9,510. So these are your total expenses. Deduct that from the total revenue. You get profit before tax. And then the provision has to be made to the extent of 31% of profit before tax as a tax provision. So this into 31%. So 4188 rounded off to 0 decimals. 4188 is basically your provision for tax. Now this provision for tax, obviously it will be part of your short-term provisions in the balance sheet. So 4188, if you go to provision for tax, 4188. And this is the total provision for taxation. Out of that you have already paid advance tax, that is 1,429, right? So net, that means 2,759 is still the balance in the provision for taxation. So once you deduct that provision for taxation, ultimately now your profit after tax is 9,321. Now this 9,321, that is the profit after tax that will get added to your statement of profit and loss accumulated balance. So 9,321 that will get added here in the balance sheet. Now first, before dividend, 5% of net profits to be transferred to general reserve. So 9,321 is the net profit. 5% of that is 466. That will be transferred to general reserve. And general reserve also will be part of your overall reserves and surplus. So 466 will be part of your general reserves now. General reserve transferred from statement of profit and loss. Obviously, it will come down from the profit, right? Because you're transferring from profit to general reserve. So 466 will be negative here. And then directors are recommending a dividend at 15%. Now dividend percentage is always percentage of the nominal value of the share capital. Nominal paid up share capital. Now what is the paid up share capital? We have already seen here. 39,900, right? Take 15% of that. So 5,985, that is basically the proposed dividend now. So obviously it is paid from profit. So it will reduce the profit balance, overall accumulated profit balance, and it is a provision for the dividend. So it will be part of your short-term provisions. So it will be proposed dividend 5,985. Then they are saying basically make a provision for dividend distribution tax at 17%. Now this will be dividend distribution tax percentage will be the percentage of the dividend amount. So we have seen the dividend amount was 5,985. 17% is the dividend distribution tax. 17% of this. So 1,017 is basically the dividend distribution tax that the company has to pay. So obviously it will reduce the overall accumulated profit balance because it will be paid out of the profit balance only. So 1,018 that will be reduction from the profit balance. Again, you will have to make a provision for this dividend distribution tax. So 1,018 will be part of your short-term provision. So everything done, even the adjustments we have closed. So now come to the balance sheet. This we have already seen. So share capital 39,900 we have already seen. Then reserves and surplus, note number 2. This we have seen, and this is all we have seen, right? So this is the this is the closing accumulated statement of profit and loss balance plus reserves and surplus 3,182. So this is done. Then this is we have seen non-current liabilities, that is bank loan. Then your trade payables, note number 4. Okay, creditors was actually come directly from the trial balance 9,222. Right, so these are the two things that we have seen. And outstanding wages, outstanding salary, these are all payable amounts, part of your trade payables. So overall 9,531. That is, then this we have already seen, that is interest, outstanding interest on bank loan. Now the short-term provisions, note number 6, all we have seen, right? So 9,762. So now your total liabilities 67,825. Now come to assets, tangible assets, note number 7, all the assets we have seen. So 27,785 done. Then other non-current assets, note number 8, which is basically nothing but your preliminary expenses not yet written off. Why these are non-current assets? Because these are to be this amount will be written off over a period of time, not in the short period. So that is why 400 will be part of your other non-current assets. And these are the amounts we have already highlighted. So we have already covered that. Overall total assets 67,825 and liabilities also 67,825. This is the question. Trial balance of X Limited as on 31st March 2012, debits, credits, and then these are the adjustments. So let us see one by one. Administration expenses. Here what I have done is basically, if you look at the trial balance, there are no salary or wages expenses. Now it is very unlikely that the company will have zero salaries and wages, right? Because in any business, there are always employees employed. So that is why I have assumed here that the administrative expenses are basically nothing but the cost of the employees, the salaries paid to the employees. So that is why 248, I have shown it in employee benefit expenses. You can make in such cases, you can make the assumption always that, it is assumed that the administrative expenses are basically employee benefit expenses in the absence of specific salary information given. Then please, in such cases it is necessary that you basically make a footnote. You show it as an assumption in your answer. So 248 done. Cash at bank and cash in hand will be part of your current assets. 100 plus 14. That is this. That will be cash and cash equivalents. Then sale of fittings, cash received. That is something that we'll see later. Let us park it aside. Then long-term loans secured 35. So this is your long-term borrowings. So 35 balance sheet under non-current liabilities. Interest on term loan 7. So obviously it is your finance cost in statement of profit and loss. Investments 100 part of balance sheet. Non-current investments 100 in your non-current assets. Income from investments, that will be part of your other income in the statement of profit and loss. Wherever necessary, please make sure that you have shown, you are showing the details in the form of note numbers. So like for example here, just by looking at other income, nobody will get to know what this other income is for. So even if there are no multiple amounts, but just the single amount, still, you will have to show it in the notes so that, the users understand what this 15 is for. So like for example here in this case, you will show note number 1, other income from investments 15. Okay, so then user understands this is income from investment. Then depreciation on furniture fittings. This is basically your credit balance. That means it is opening provision for depreciation balance 130. So that will be part of your notes in balance sheet under tangible assets. So 130 is basically your opening provision for depreciation. Because in the balance sheet, ultimately the assets will be shown net of depreciation. Then you have distribution cost 51, which will be part of your other expenses. So if you go to note number 3, distribution cost 51. Then factory closure cost. Now this is basically, say, for example, the company has closed down one division. In that case, it will be basically incurring some closure cost. Now this is an extraordinary item, right? In the regular course of business, there will be no closure cost. So that is why this 30 rupees will be part of your extraordinary items in the statement of profit and loss. Extraordinary items are the items which do not occur in the ordinary course of the business. And exceptional items are basically, the items are basically regular in nature, but the amount or the transaction that has happened is something exceptional. So that will be basically an exceptional item. So like, for example, suppose you have, suddenly incurred a major amount as bad debts, which is exceptional in nature. Normally, this is not the bad debt amount that usually is basically, lost. So in that case, but the bad debts as such is a normal, is a normal item which appears in your regular day-to-day course of business. But if it is exceptional amount, then it will come in exceptional items. But if the transaction itself is basically abnormal, then it will be part of your extraordinary items. So closure cost will be part of your extraordinary items. Furniture fittings, equipments at cost, part of your non-current assets 340. Then you have profit and loss 40, which is nothing but the opening accumulated balance of statement of profit and loss, which will be part of your reserves and surplus. Purchase of equipment 60. So this is basically the additional equipment that you have purchased. Again, it will add to your fixed assets. So if you go to tangible assets, notes to accounts 60. Then purchase of goods for resale. Now obviously this is part of your purchases 855. Then you have sales 1500. Part of your revenue from operations. Share capital 500, that will be part of your share capital 500. You will obviously show the notes to accounts, and in that, if authorized capital is not given in the question, still you will write in the notes to accounts authorized, but if the amount is not known, put it as a question mark. Authorized share capital doesn't come in the balance sheet, main balance sheet. It's just shown as an additional information in notes to accounts. What goes in the balance sheet total is basically your paid up capital. So you have basically 50,000 equity shares, 10 rupees fully paid up. So 500. Then this is your opening stock given in the trial balance. So it will be part of your, obviously, the changes in the inventories. So as I said, basically opening stock minus closing stock, the net amount will be shown here. Then creditors 40 and debtors 390, part of your balance sheet. So creditors will be part of your current liabilities 40, and then debtors part of your current assets 390. 340, that was the opening fixtures, fittings, tools and equipments as per trial balance. That was part of your tangible assets. So this is done. Trial balance is done. Now coming to adjustments, there is only one item left that we have not seen, that is sale of fittings, that we will see later. Now stock estimated to be 1 lakh. So this is your closing stock. So closing stock, again it will be deducted from your changes in inventories. So 100 deducted. 1 lakh, that is all the rupees are in thousands. So 1 lakh will be in thousands, it will be 100. So minus 100. And then obviously this will be part of your inventories in current assets. 100. Now it says depreciation on furniture, fittings, tools and equipment is charged at 20% per annum on cost. It says a full year's depreciation is charged in the year of acquisition, but no depreciation is charged in the year of disposal. What this means is that if during the year, if you are acquiring any asset, equipment, then on that equipment you will charge the depreciation for the full year during that year. But if you are selling the equipment or that particular asset, then no depreciation will be charged in the year of sale. That is what it means. Now this adjustment and the next adjustment we will see together. This says during the year the company purchased 60,000 of equipment, which basically obviously has already come here, purchase of equipment, right? We have already seen the effect of that in the balance sheet, notes to accounts. And then they are saying it also sold some fittings which had originally cost rupees 30,000 for rupees 5,000. So this 5,000 is nothing but basically the sale of the equipment, 5,000. And for which depreciation of rupees 15,000 had been set aside. So original cost was 30,000. Accumulated depreciation on that is 15,000. So your WDV is basically 15,000. So 30,000 minus 15,000 accumulated depreciation. So 15,000 is the WDV and you have sold it for 5,000. Correct? So that means remaining 10,000 is the loss on sale of equipment. Correct? So how we will treat it basically is that. So two things. One basically, 5,000 is basically received by way of sale of equipment. So that must be already part of your cash and bank balance. Your accumulated depreciation 15,000 on the asset which is sold. Obviously that will have to be transferred to the asset account and it will no more be part of your provision for depreciation because now the asset is sold, and that is why in your balance sheet this 15,000 will be deducted from your provision for depreciation because now the asset is sold. 10,000 is basically your loss on sale of equipment, which will be part of your other expenses. So loss on sale of fittings. Now let us see how we will calculate the depreciation on this. So now what is the cost of the equipment that was sold? 30,000, right? So obviously this will be deducted from the overall equipment cost. So your net cost is now 370. On this you are supposed to calculate the depreciation for the current year. What is the depreciation rate? 20% on cost. So 20% of 370, that is 74, is basically the depreciation that you will charge in the current year, right? So 74 will be part of your depreciation, correct? And this is the working for that. This is your cost, net cost of the equipment, and 20% of that is your depreciation. Done. Then what other depreciation they are talking of? Okay, that's the only depreciation. Then they are saying make a provision for income tax, that we will see later because this will be on the profit. Factory closure cost is presumed to be allowable expenditure for income tax. So that means it is to be shown as an expenditure when you are calculating the income tax. Then company transfers 15,000 to reserve. Now when company is transferring 15,000 to reserve, it adds to your reserve balance and is getting deducted from your profit. So it will be in the balance sheet. So 15,000 will come to your general reserve and it will be basically deducted as transfer to general reserve from profit and loss balance in the balance sheet. Payment of dividend 20%, provision for dividend distribution tax 17%, we'll see later. So let us close the statement of profit and loss. This is something we have already seen. Now second depreciation amount, note 2, 74, we have already done that, seen. And then other expenses, note number 3, we have already seen both. So 61. Okay, so total expenses done. Profit 1,515 minus 1,215. So 300 rupees. Factory closure cost we have already seen, extraordinary items. So your profit before tax is now 270. 300 minus 30. Now you will make a provision for tax. 31% is basically the provision for tax. 270, 31%, 83.7. So that is rounded off to 84. So provision for income tax 84. So your profit after tax 270 minus 84. That is 186. Now this 84 provision for tax, that will be part of your short term provisions. Provision for taxation 84. Okay. Then they are saying basically after this tax provision is done, now you will basically calculate the dividend. Now the dividend is 20% of your share capital. Your share capital is 500. So 20% of that is 100 rupees. That is your proposed dividend. So now proposed dividend meaning obviously it will be from your profit. So in your balance sheet, reserves and surplus, 100 will be deducted from your profit and loss balance, and that will get added to your short-term provisions, proposed dividend. Then they have also asked you to basically make a provision for dividend distribution tax, which is 17. Again, this will be 17% of your dividend amount, which is 100. So 17 rupees in short-term provisions. Obviously, it will be paid from profit. So it deducted from your profit balance. Now, this is 186, which is the profit that you have made during the year, which we have seen here just now. That will get added to your reserves and surplus, because that is the profit made during the year. So 186 will get added here. Reserves and surplus 186. Correct? So now statement of profit and loss is over. Let us come to the balance sheet. Okay. Share capital we have already seen. 109 reserves and surplus. In notes to accounts we have already seen the breakup. So total reserves and surplus now 109. This is done. We have already seen. This is seen. Short-term provisions, note number 4. These are the 3 numbers that we have already seen. So sum 201. Already done. Total liability is 885. Now fixed assets, tangible assets, note number 5. Okay, all these things we have already seen. This is also seen. Right? So this is your net provision for depreciation balance. Once you deduct that, 370 minus 189, 181. All other items we have already seen. So the total of assets, again same 885, tallies with your liabilities total.